Yeah, so can anybody unmute himself or herself so that I can know?
Yes, sir, it is visible.
Okay, perfect. Thank you so much. So we'll quickly move on to our topic of discussion. This is our chapter 10 of our program, that is Investment Pro. And I welcome you all in this session. The topic for the day will be basics of currencies. So your major key takeaways from this session will be what are derivatives, why derivatives, different currency markets in India, some important terminologies that you should know before entering into this market, how to trade in currency, what all you can do in currency market, why you should trade in currency, and what are the risks involved, or what are the points that you should remember before entering this market. So again, the whole session will revolve around derivatives only. So it is really important for us to discuss what actually derivatives are. I know we have covered this, what are derivatives, from past 3-4 days, but it will be a sort of revision for you all, those who attended our sessions earlier, and for those who could not attend our session, it will be a kind of some giveaway, like not giveaway, it will be some sort of information for them so that they don't feel left out. Okay, so what actually a derivative is, uh, it is a security with an underlying asset. The value is determined based on the underlying asset. We have discussed an example of wheat, and the derivatives from wheat will be your chapati, bread, butter, ghee, curd, or all these things. So underlying asset. Oh, I'm sorry. Sorry, I took an example of milk now. We were talking about wheat, so our derivatives will be wheat, bread. Sorry, chapati, bread, and cookies. Okay, so these will be our derivatives, and wheat will be our underlying asset. So the value or the price of, say, chapati or bread is directly proportional to what the price of wheat in the market is. So same thing, we are telling you it is a security with an underlying asset. The value is determined based on underlying asset. The value of, say, bread is determined based on the value of wheat in the market. Some most common underlying assets are stocks, commodities, currencies, and market indexes. To be on a broader scale, we have already covered with stocks, we have covered with commodities. Yesterday, we took some portion of market index as well, and now today we will be discussing about currency segment. A very important characteristic of derivatives market which attracts people is it is characterized by high leverage. That means you can play a game worth rupees lakhs with a very small amount of investment. How we can do it, we will discuss it in upcoming time. So again, in there are basically 5 types of derivatives: futures, options, swap, forwards, and so on. So but basically, or more specifically, these two are the majorly known for, like majorly majorly followed by people. So you will mostly hear people about speaking about future contracts, options contracts. So this is something which we will be discussing to right now. So first of all, talking about futures, what actually futures contract is. A future contract, okay, so a future is a contract, and its value is dependent directly on the price of underlying asset. what will be the future contract value of, say, Reliance directly depends upon what is the spot price of Reliance. For those who could not understand what actually a spot price is, it is nothing but the price of Reliance share in the cash market, or more specifically in NSE or BSE. So again, a very important aspect of futures contract or in derivatives market, trade happens in lots. For every stock, commodity, or any other, say, financial instrument or any other thing, a lot size has been defined by the stock exchange. So you can trade only in lots. The margin required is just a percentage value of whatever your contract value is. So suppose if you are buying future contracts of, say, Reliance, so you don't have to pay, say, like what example we took yesterday, we wanted to purchase 100 shares, or sorry, 4,000 shares of 100 rupees each. So our contract value will be 4 lakh rupees, but we don't have to pay the whole amount of 4 lakh rupees. We just need to pay a certain sort of percentage amount, and then we can enter into a future contract. Another important aspect of futures is you have unlimited profits, like you have a chance to make unlimited profits, but on the same time you can incur unlimited losses as well. The future contracts have a fixed expiry date. We have discussed about this previously as well. There are 3 expiry periods. The first one is near month, second one is next month, and the third one is far month. Talking about what actually options are, options are a contract that gives you a right to buy or sell, but not an obligation. Okay, so the rates are predetermined, just like as in futures. The rates are determined in options as well. Again, you trade in lot size only. Now over here you don't have to pay that percentage amount. This percentage amount over here in options contract is termed as premium. So what your margin requirement is, it is nothing but just the premium that you have to pay in order to buy a contract. In our example, we took an example of a house which we wanted to purchase at 50 lakh rupees. For that, to our builder, we paid a token money of 50,000 rupees. So, in this case, this 50,000 rupees will be termed as a margin or a premium that we have paid in order to buy that contract. Okay, so in this contract, you have a chance of making unlimited profits, and at the same time you can incur only a limited loss. Your loss is limited only to the amount of premium that you have paid in order to purchase this options contract. Suppose you paid 50,000 rupees to your builder to book that particular house, but now you don't want to buy it. Why? Because the value of house has went down from 5 lakh to 4 lakh 50,000, sorry, from 50 lakh to 45 lakh rupees only. So in this case, you are incurring a loss of 5 lakh rupees. So in order to safeguard your 5 lakh rupees, your premium amount, which is 50,000 rupees only, you can easily forego it. Guys, give me a minute. Okay, so in our options contract as well, we have fixed expiry date, just like we have in futures contract. That is, your first one will be your near month, the second one will be your next month, and the third one will be your far month. Now, why derivatives market? Okay, so this is very important aspect. Like, why do people actually go for derivatives section? See, if you want to purchase a particular stock, okay, so you have just 100 rupees in your hand, and that stock is also of 100 rupees. So if you are trading in equity market, or more specifically in cash market, then you can buy only one quantity of that stock as per your pocket. You have 100 rupees only, you pay 100 rupees and get one stock. Okay, but in another situation, you want to purchase an equity future contract. So just suppose you are purchasing Reliance share at 100 rupees, you are getting just one. Now you are in equity derivative section, so you can purchase Reliance share in futures market as well. There, suppose you need to give just 20% as a margin money. So 20% of 100 will be just 20 rupees. So with 20 rupees you can buy one, say one share of Reliance. So with that same 100 rupees you can buy five shares. Okay, so even if the price goes up by 1%, or in our case it goes up by 1 rupee as well, your profit will be 5 rupees. Whereas if you were trading in cash market, if price goes up by 1%, that is 1 rupee, you were just making a profit of 1 rupee only, because you had just one share of Reliance. Again, a very important thing which I want to convey you people, I am just taking an example over here. Remember, there is some sort of lot size which you have to purchase. Okay, so just for sake of simplicity and easiness of understanding, I'm telling you this. Okay, so over here you invested 100 rupees in Reliance equity future, like 20 rupees into 5, so you got 5, say 5 shares of Reliance, and you earned a profit of 5 rupees on this contract. So 5 divided by 100 multiplied by 100 gives you a return on your investment of 5%. Similarly, let's see now in currency futures, the margin requirement is is very less as compared to what is required in equity futures market. Similarly, in currency futures, there's like currency derivatives market also, or currency market also, the margin requirement is lesser than the equity future market. Okay, so over here now you need to pay just 3.5% of margin. With this you will be able to get 28 units in your account. If you will divide 100 by 3.5, you will get 28 units. In equity, like equity futures, you were getting only 20 units. No, sorry, you were getting only 5 units, I guess. Yeah, and over here you are getting 28 units, so straight away 23 units more. So if the price changes by even by 1%, you are making a profit of 28 rupees, and your return on investment will be 28. Are you all with me till now?
Yes, sir.
Yes, sir.
Okay, perfect. So this is why derivatives market attract many people towards itself. But before diving into derivatives market, it is very important that we have a very fair understanding about the market. We are confident enough to play such a big game, because if you can make a lot of money in this market, you can lose a lot of money as well. So it is really important for us to be confident in cash market first, then it is advised to jump into derivative section. Okay, so now we'll discuss some important terminologies. So the very first which we will be discussing is currency. So when money is branded, it is called as currency. Whenever there is a cross-border trade, there is need to exchange one brand of money for another. And this exchange of two currencies is known as forex exchange, foreign exchange, or simply forex. Okay, so talking about what are exchanges that on which you can trade for a currency market, it is NSE and BSE, where on 29th of August 2008, NSE first started with trading between USD and not between, in USD INR. So what do I mean by USD INR? I will let you know after 2 minutes. Just pay some attention to what I am trying to say you. On March to like by March 2010, NSE started like providing facilities for trade in Euro INR, Great Britain Pound INR, and Japanese Yen INR. And by like February 2018, which is very recently, NSE allowed cross currencies like exchange as well. So what do I actually mean by USD INR is something which we'll study in types of currency. So there are different types of currencies in which you can trade. Majorly, some very known ones are USD INR, JPY INR, Euro INR, and GBP INR. So USD INR, I think everyone know. It is the price of $1 in terms of Indian national rupee. Similarly, JPY INR is the price of 100 Japanese yen in terms of Indian rupees. Euro INR is the price of €1 in terms of Indian rupee. Great Britain pound, or yeah, so this is the price of one British pound in terms of Indian rupee. USD JPY is the price of $1 in terms of Japanese yen. GBP USD is the price of one British pound in terms of US dollar, and Euro USD is the price of one euro in terms of USD, like US dollars. So the term which is written first is the is the main thing, and the second one is something to which, like in terms of which it is like valued. Okay, so what is the value of INR based on USD? Like in order to buy one US dollar, how many Indian rupee you have to pay is something which it defines to you. Okay, talking about some more important terminologies. Over here you have pairs. So what actually a pair is? It is nothing but this USD INR is termed as pair. Each traded currency is known as pair. USD INR is a pair, JPY INR is pair, Euro INR is pair. In this situation, Great Britain Pound INR is a pair. So basically, these four are something which are really important for us because we can trade in these also. I'm not that sure about these, like does NSE or BSE allows us to trade in these. Okay, so pairs is something which we have already discussed now. What actually appreciation or depreciation is? We will talk about both these situations with an example. So here is my example. Let's say on January 2021, Euro INR value was 91 rupee, like 191 rupees. So in order to buy one euro, you need to pay 91 rupees. On January 2, it closed somewhere around 90 level. So now what means over here is, in order to buy €1, you need to pay 90 Indian rupees. So as per this situation, the value of Indian rupee has increased, and there is an appreciation in the value of rupee. On the same hand, there is a depreciation in the value of euro. Earlier, you need to pay 91 rupees to buy a euro, 1 euro, and now you have to pay just 90 rupees. So, in this situation, your value of rupee has increased. So, it is an appreciation, whereas the value of euro in terms of INR has decreased. So, it is a case of depreciation. Suppose on January 3rd, Euro INR was at somewhere 90 points, and on January 4, Euro INR again went to 91 level. So now what is the situation? On January 3rd, you were required to pay just 90 rupees in order to buy 1 euro, and today you need to pay 91 rupees to buy 1 euro. So in this situation, the value of rupees has decreased, and this is termed as depreciation of rupee, whereas the same situation will be an appreciation of euro. I hope I am making some sense and you are able to understand me. Guys, please reply so that I can move forward.
Sir, please explain this again, sir.
Okay. Let's suppose in order to buy 1 euro, you required to pay 91 rupees. Okay. On January 1. On January 2, you were required to pay just 90 rupees in order to buy 1 euro. So in this case, the value of rupees has increased. It is a vice versa situation, like what we have studied till now. In if you are from commerce background, then you might have heard like appreciation means the increase in value and depreciation means decrease in value. But over here the situation is vice versa. If the current market price falls, it is termed as appreciation of rupee or appreciation of other thing, and if the current market price increases, it is known as depreciation. In order to buy 1 euro, you were required to pay 91 rupees. Now, on January 2, in order to buy 1 euro, you just need to pay 90 rupees. So, in this case, the value of rupee has increased, and this is known as appreciation of rupees. Even the market price has went down, the value has increased. So it is appreciation of rupee, whereas it is depreciation of euro. On the same in the same situation, let's see on 3rd of January, euro INR, like you need to pay 90 Indian rupees in order to buy 1 euro, and on 4th of January you required 91 rupees to buy 1 euro. In this situation, you have to the current market price has increased, but the value of Indian rupee has decreased in the market. That is why it is known as depreciation of rupee and appreciation of euro. Now are you clear?
Yeah, yes, sir.
Okay, thank you so much. So we have talked about appreciation and depreciation. Now a contract, like we are discussing this from a very long period of time now. It is nothing but some sort of commitment by two parties, and a binding commitment between two parties. So in which one agrees to buy and the another one agrees to sell. Similarly, for expiry, it is a bit different from what we have already discussed in derivatives market. Like there is no expiry term like near month, far month, or next month. In this, the expiry will happen 2 days prior to the last working day of the month, and that is also at 12:30 p.m. Okay, so let's suppose 29th of July is the last working day, and 31st the market will remain closed. Okay, let's suppose. So your expiry for that particular contract will be on 27th of July only, 2 days prior to 29th of July. And also
Sir, you are on mute. We are not able to hear you.
till when were you able to hear me?
On 21st July, you're saying something, sir. July.
Uh, okay, perfect. So I think I was talking about expiry then. Okay, so let's suppose 29th of July is the last working day. So your contract will like close at 27th of July only, and you have to square off your position by 12:30 p.m. anyhow on 27th of July. Okay, and talking about modes of settlement, everything over this in this market is done on cash basis, and that is in Indian rupees. So if you make money in this market, you will get Indian rupee in your hand or in your bank account. And if you lose your money, then you have to pay whatever the loss you have incurred in rupees form only. So it is not like if you are trading in USD INR, then you have to pay dollars if you lose your money, and you will be given dollars if you make money. No, you will be given Indian rupee only. So final settlement price, it is something which fluctuates as per RBI reference rate. So like it is something which is not that important to understand, but I just wanted to give you a hint. Like there is another term which is known as final settlement price. So it completely depends on what is the RBI reference rate. Okay, so now we will move forward. Like how do you actually trade in currency market? Let's suppose today the price of Great Britain pound and INR is rupees 92. So that means that for 1 pound you need to pay 92 rupees. Okay, and like I think I have already told you that. No, I didn't told you about this. Okay, so the lot size is 1000 units. Okay, so if you buy one lot of GBP INR, then it means that you are purchasing 1000 units. Okay, so in order to tell this 1000 units, I can also say that you are purchasing 1000 pounds. So as per the current market price, for 1 pound you pay 92 rupees. So for 1000 pound you will pay 92,000 rupees. But since we are in a derivatives market and in currency market as well, you just need to pay a margin money. This percentage is what we have taken. for our reference. So let's suppose we need to pay 3% of margin money. So 92,000 multiplied by 3%, we'll get an amount of 2,760. So in order to buy one lot of GBP INR, we need to pay just 2,760 rupees. And let's suppose the very next day, the GBP INR went from 92 to 92.5. That is, went up by 50 paisa. So 50 paisa multiplied by $1,000 euro, or sorry, pound, or 1,000 unit will give you 500 rupees straight away profit. And if you will calculate what is your return on your investment, then you will divide 500 with 2,760 and you will multiply it, the resultant, with 100, so that you get a proper percentage. And over here your percentage return is 18.1%. Okay, so you purchased GBP INR at 92, even if it went up by 0.5 paisa, that is 50 paisa, then also you are making a profit of 500 rupees, which is 18.1. Like most of the this 3%, this 50 paisa is just a hypothetical situation. We have just tried to convey you. There is no such amount, like it is not compulsory that your margin requirement will be 3%. Okay, it can be more than that as well, or it can be less than this as well. Taking another example to make things more clearer, let's suppose today, in order to buy $1 you need to pay 71.5 INR. Okay, so this means that $1 is equal to 71.5 INR. In one lot of USD, there are again 1,000 units. So your total amount of investment will be 71,500. How? You will multiply 71.5 with 1,000 and you will get this amount. Now in order to buy one lot, you just need to pay, like, suppose 2.1%. So in this situation you just need to pay 1,428 rupees. Let's suppose the very next day the price goes up to 72 rupees. Okay, so in this you will make a profit of 500, right? Are you all with me till now? Like, you are making a profit of 500. Guys, please reply. Hello, am I audible?
Yes, sir.
Okay, so do let me know, like, if I'm audible or am I clear. Okay, so in this case you can take a profit of 500. This is something, let's say, if you have taken an option of this particular contract of and okay, so this is something which I didn't wanted to, like, cover right now. We'll get back to this after some time. So going straight away with what we discussed earlier, you have earned a return of 500 rupees. You will divide this 500 with 1,428, which was your amount of investment. you will get a return of straight away 35%. Okay, so if you purchase a future contract of USD INR and this situation happens, then you are making a profit of 35% of the invested value of your like the invested money that you have invested to purchase that particular future contract. We'll come back to this after some time. So what all can you do in a currency market? Like, yes, if we are in market, then we have to do something. So you can buy or sell the future contract, you can buy a call option or sell a put option, or you can buy or sell any call option or put options. You can spread trades in futures. Okay, so what do I actually mean by spread is there are basically two types of spreads. The first one is calendar spread, the second one is cross spread. So in calendar spread, you take two opposite positions in two different time frames. Okay, so basically what you do over here is, let's take an example. You buy a current month future and you sell the next month future. So this is something which you do while you spread your trades in future in calendar spread. Okay, so let's suppose you had a bullish overview for this month. So you took a chance and purchased a future contract, and you made a buy position in the market. And on the same day or in the same month, what you did is you sold the next month future, and you created a short position for the next month. So this whole activity is known as calendar spread. Okay, and what do we understand with the term cross spread is, here you go long in one currency pair and go short in the another currency pair simultaneously. Okay, so you believed that today or in this month USD INR might give me a good returns and I can be bullish on that. So you created a buy position in USD INR futures, and you created a say bearish overview, or you created a short position in say GBP INR. So this is known as cross spread, where you go long on one currency pair and simultaneously you go short on another. Are you all clear with this?
Sir, please explain again.
What do you want me to explain, like calendar spread or cross spread or both?
Both.
Okay, so we'll discuss cross spread first. Like suppose you were having a bullish overview about USD INR. You thought that the value might go up in upcoming time, so I can earn good money from this USD INR trade. So you purchased a future contract and you made a buy position in the market. Simultaneously, you thought that GBP INR might go down in this month. So you created a short position in GBP INR futures contract. So this activity which you have done right now, you have gone long with USD INR and gone short with Great Britain Pound INR. This activity is known as a cross spread. Similarly, for a calendar spread is like you were having a very bullish overview about USD INR only. Okay, so you thought that in this month USD INR will go up, so you purchased USD INR future contracts. Okay, on the very same time you thought that USD INR might go down next month, because I have done my analysis. I'm getting some good calls that yes, up to this level it can go, after that it will go down. So as per my analysis, I can assume that in this month USD INR will give me good returns by going up, and in the next month it will go down. So I will create a short position for the next month and buy position for this month. So this activity is known as a calendar spread. I hope I am making some sense.
So, sir, can be opposite of it. I short this month and long on
Yeah,
other
yeah.
month.
Like vice versa situation can be there. If you think that right now USD INR is falling, so it will fall for this month. So I will create a short position here, and for the next month I am making a buy position. So this is also known as a calendar spread only.
So, like if I've sold this month, then I have to buy again this month before the expiry.
Uh, if you have purchased the future contract, then if you have made a profit, you have to square off your like whatever position is, and whatever your profit or loss will be, it will be transferred to your bank account or trading account, sir. Like we are
So, like if I short today, then I have to like again buy it at the end of the month, right?
yeah, yes. Whenever you want to square off your
Okay.
position, then you have to close the contract. So you have to buy it. Okay, so now talking about currency commodity spread. Currency commodity are known to move uh, in tandem, gives the client additional opportunity to make profit by taking position in currency and commodities simultaneously. Okay, so this is something which is a little bit like not that useful for people like us, because we are just beginners right now. So but yeah, if certainly like there are people or there are hedgers who do these kind of activities very well. So let's suppose, um, let me think of a better idea, like to give you a better overview. Currency commodities spread, okay. Okay, so what happens in market is, currency and commodity market is, uh, currency, like if suppose currency market is doing really well, then you will for sure see that commodities market is also doing good. These both are, uh, if I can say, like wheels of a same cycle. Okay, so if one is moving in an in particular direction, the another tire will also move in that direction only. So if like you are in commodities market, and commodities market is giving you certain good returns, then you can see that currency market will also give you certain sort of returns. But in order to catch that thing in market, it is important that you have a very good overview about commodities market as well as currency market at the same time. So that is why this is something which will like which we people like who are beginners in these market will not be able to catch immediately or very properly. Once you will start developing your knowledge about these markets more, in some intermediate or advanced level knowledge, then you will know get to know about what actually currency and commodity spread is. Okay. Similarly, hedging against equity market is something which is done by big institutions, like big institutions. Um Currency market and this equity market both work in an inverse direction. So suppose if your equity market is doing really great, then Sensex and Nifty are on an upward side, then most likely your currency market, or say USD INR, GBP INR, will end up at a lower price. Okay, so this is something which is quite often in the market. So what you can do is
So
you
it means that rupee will depreciate.
Rupee will depreciate. No, rupee will appreciate. The situation is different. The value of, like, say if market is doing good, okay, uh, Sensex or Nifty is on an upside, then the situation will happen. Euro INR will go down. This is termed as appreciation of rupee. So this is pretty like a sort of situation which confuses most of the people. Even many a times, many people get confused like what actually appreciation is. So taking example of this situation, let's suppose Nifty today closed at very like a good high. Okay, let's suppose it went up by 150 points today. So this will be the situation which will happen in currency market, ideally. Okay, so in this situation, the currency market will close at a lower rate, and this is termed as appreciation. Whereas if say today Nifty goes down by 75 points, then this situation will arise from 90.
So, sir, why is this relation there? Like, why is it inverse?
There are many other like things which affect this. We'll discuss this. Give me just a few more time so that like I'm coming to this point only. So for the time being, you can remember like if equity market is doing well, then currency market will go down. And if say equity market has gone down today, then you will see green ticks in currency markets. Okay, so you can as per your risk reward ratio or risk management, you can hedge against equity market over here, so that if you make loss in equity market, you gain some profit in currency market in order to reduce your like loss, or in order to gain more profits. Okay, so what are the major situation, or what are the major things which create such inverse relation, is something which we will discuss in coming few minutes. Okay, so who are the key market players, or who are the key participants in this particular market? Is uh, the one thing is remains that constant that remains constant is traders. Exporters and importers are major market players, because they really are the ones like who will trade off between, and who would require actually these money. Say suppose if someone is there in US and I'm sending them some goods, then they will give me money. So it is important for them as well what actually is the price of their currency in market. And for exporter, like for me, is also, it is also important because there is a very huge fluctuation in the market. So we need to keep an eye, like um even small percentage creates a big difference in the final amount. So exporters and importers are the ones who are also a key market players in this section. And banks and financial institutions, again, because it is related to currencies. And let's suppose uh, they also give some loans or get some loans from other players or other people. So then again, if someone is going out or coming into your country, then they will have to like um, exchange their money. So in these situations where these financial institutions play a very important role in this market. Okay, so now what are the factors that actually influence the rate of exchange, or that actually like affects the currency market? Is the first one is inflation rate, the second one is interest rates, the third one is what is the balance between exports and imports. So like the rates of any particular currency is determined by what is the volume of that particular currency with our reserve bank. Okay, so if there are more imports, then we will lose that particular commodity, that particular currency. For example, if we are purchasing say goods worth rupees $100, okay, from US only. Okay, so in this situation we will pay them $100, and let's suppose we had a reserve of only $900, or sorry, $1,000, and we have paid them $100 out of it. We are left with $900 only now, and they're in their reserve in their account for, let's say, Indian rupees will for sure increase. Or um I hope I am making some sense, like I'm able to tell you people what I'm trying to convey. I think I can't simplify it more than this. So your reserve of US dollars will decrease, and on the same time their reserve will increase. So this is something which we call as trade balance. So importing a lot of things is also not good for an economy, and exporting a lot of things is something which increases your uh, forex reserve. So it strengthens your currency. Just take an example, forget everything. um, let's suppose only 100 rupees or 1000 rupees is the amount which our government has printed till now. Okay, only 1000 rupees, out of which say 500 is with the US, and no other country has anything for us. Okay, and the remaining 500 is with the people of India. Okay, so now let's suppose there is someone who is from uh, let's take an example of who is someone from Pakistan. Okay, so he, if in order to buy anything from India, they need to pay us rupees. But how will they pay us rupees? Because they don't have anything. So Pakistan will create a demand of Indian rupee in the currency market, because of which the prices of Indian rupee will go up, because higher the demand is there, the prices go up. Similarly, if there is a way, lots and lots of supply in the market, the value will get decreased. The same thing is happening if we are importing a lot of things, we are releasing a lot of Indian rupee in the market. The supply will increase, that will reduce the value of our Indian rupee, or it will reduce the strength of rupee in the market. Whereas, taking an example of, say, China, they have a very huge amount of exports, because of which their currency is in a very good demand. And since they are importing very less, they are releasing their money very less in the market. And because of demand and supply forces, the prices vary. So that is why it is really important for an economy to maintain a good trade balance. Are you all with me till now?
Yes,
Yes,
sir.
sir.
Okay, perfect. This is volume of international reserve with the central bank. In our case, it is RBI. We have already discussed. The more US dollars RBI will have in their reserve, the stronger Indian rupee will be. Being stronger, I mean that the value of USD INR will go down. If suppose USD INR today is at 72 level and RBI's US dollar reserve increases, then USD INR will go to 70 units or 65, 68, 69, whatever the amount is. Okay. Like what is another important factor that influences the rate of exchanges? What is the attractiveness of your domestic environment? Like if people outside India are thinking that India has a very good huge market and there is a very huge potential of Indian markets to grow, then they will invest their money in the Indian stock markets or in Indian property or any other thing, because of which again the international currency reserve of a country will increase. If suppose there is a person who is sitting in America and investing 1,000 or 1 lakh US dollars in the market of India, then it is a very huge amount of investment in Indian like Indian stock market or Indian business, which is also termed as domestic investment environment. So the more attractive your market will be, the more foreign investment it attracts, and the more foreign investment there will be in the economy, your currency market will also prosper accordingly. Okay, there are other economic indicators, and in order to play your games in currency market, it is really important that you uh, have a very good understanding about the various macro level economic indicators and various other global issues that are happening in the market. Say, suppose if Great Britain pound and Japanese yen is also showing some movement, then these things might hamper or might affect the value of GBP INR as well. So you need to have a very broad overview about the economy, about the world, in order to be very successful in currency markets. Okay, RBI reference rate is nothing but it is something which like we will take into consideration when we are squaring off our position or when we are like settling up whatever our loss or profit was. Okay, now talking about why should you trade in currency market. It is one of the biggest financial market in the world as of now. That is pretty much clear because uh, whatever we are doing is for just money, and in this case we are trading in money only. So obviously it will be the biggest financial market. It is very like not that simple to trade and easy to understand, but there are certain like sort of things or certain kind of experience that you gain once you are in the market. So it creates a situation where like once you are experienced about this market, it is very simple to trade and easy to understand market. Least capital is required. Why? Because you have a very good amount of leverage. You just need to pay very minuscule amount of margin money in order to enter this market. So this is something why you should trade in currency. If you would have seen, there is a subtle difference between futures and options contract of equity market, commodities market, and currency market, where equity market futures and contracts have a pretty much higher amount of margin required. The margin requirement decreases in commodities market, and the margin requirement in currency market is pretty much lesser than commodities market also. So this is why you require least amount of capital in this market. Funds from equity account can be used to trade in currency market. So if you have your amount in equity section of your trading account, you can use that amount to trade in currency market as well. Okay. Um, this currency market, like we have already discussed, this works in correlation with certain things, like commodity market and currency market moves in same direction, whereas current equity market and currency market moves in like inverse directions. So you can correlate them with the other markets. There is a reasonable volatility to trade in, like you if you are looking to make money, then this market is something which have a reasonable volatility. It is not like if today ISD UNR is at 72, tomorrow it will go to 80, 85, or it will go down to 60, 65. No, such huge chances, like such huge volatility is something which is not very usual. It happens very rare situations. So a reasonable volatility is something which this market has to offer you. Lower brokerage structure, it completely depends on different brokers or broking agency, like what is their brokerage structure, but usually it will be lower than commodities market and cash market, or future equity futures or contracts. You have more trading time. This whole market is open for 24 into 7, so you can trade anytime you want. Research recommendations is something which your broking agency provides you. Like for currency market, these agencies provide you good number of research recommendations. So if you even don't have call, you can believe certain sort of people only if you are successful with that. And it completely depends on your risk taking ability, that whether you want to be sure of yourself, you can trade on someone else's recommendation. So this is something which has risk involved is leverage risk. Since uh, there is some sort of volatility in market, you need to maintain the margin money that is required at any time, any period of time. Interest rate risk, no, sorry, transaction risk are an exchange rate risk associated with time difference between the beginning of contract and when it settles. So forex trading occurs on a 24-hour basis, which can result in exchange rate changes before trade have settled. So what can you assume from that is uh, transaction risk are exchange rate risk that are associated with the change in time before, like say you entered into a contract today at say 75 rupees. You are trying to settle off your position, but because of some time differences or some other things, you can't turn off your position, then this situation will be termed as a transaction risk. Okay, so the next point is counterparty risk. A counterparty is a financial transaction, like a counterparty is a company or any other person which provides the asset to investor. Okay, so let's suppose you are entering into a particular trade with an intermediary in between. Okay, so you can't directly go and place your orders. You have to go through your broker, and then your broker will place orders, and these sort of things will happen. But many a times it has been seen in currency market that because of time differences and due to other various things, that are prevailing in this market, many a times your transactions are not carried out properly, or due to high fluctuation the prices go up and down, and you might incur some losses. So this is a situation where you can like have a risk of counterparty. Similarly, there is a country risk. A currency crisis can occur due to frequent balance of payment deficit. Like as I have already told you, if some country or some economy is just doing more and more imports and is not exporting a lot, this will create a deficit in their trade balance. It will create a situation where they will be left with no reserves, like no foreign reserve in their account, and their whole money will be out in the market. Because the market money is out, there will be a huge supply in the market, and the strength of their money will go down in the market. So in such situations, there is devaluation in currency. And let's suppose like you entered into a future contract or any, like into any say any currency any currency, and because of balance of trade deficit, the value has gone down or there has been some devaluation in the currency, then it is something which comes under current country risk. And this is something what are the actual risks involved in this market. Things to remember: always maintain a necessary margin, because there is a very decent amount of volatility in the market. So you need to maintain necessary margins in your account, otherwise your positions will be squared off. Buy like it is usually recommended to people that they should buy more than one lot of anything. Like if they are entering into USD INR contract, then advisably they should buy more than two lots, so that they can earn good returns. Before entering into this market, you should have a very decent knowledge about futures and options segment, because this whole segment of currency market works on this only. And if you're not clear with futures and options, you have no experience about futures and options trading, then like there are high probabilities that you will end up losing your money. Try and take positions for a shorter time frame if you are beginner or you are an intermediate level of say trader, because shorter time frames are easier to be plotted on graphs. And like you can create your position for 7 days, 10 days, 15 days based on your technical analysis. So that is something which is something you should keep in mind. Also, since the world is so rapid these days, it is so fast, any sort of bad news might come up. So if you would have created a position keeping in mind a 2-3 month overview, then certainly it might happen that suddenly a bad news comes into there is something very good about another country. So it might happen that you lose your money. So try to make a position for a shorter time frame first, gain some confidence, then you can go for longer time frames. Maintain good risk reward ratios for your positions that you have taken. You can try to hedge between like your currency market and equity market, or if you are able to understand what commodities market is doing right now, you have a decent knowledge, then you can like maintain your risk with that market as well. Balance to be maintained a little more than the amount you are planning to invest. This is something which will come under always maintain the necessary margin only. If you have entered, like you were having a view that I should enter for 2000 USD INR, then keep a money of say 2500 or 3000 rupees in your account. So whatever you were planning for only 2000 rupees, it is advisable that you maintain 3000 rupees so that it will turn up as a margin requirement as well. Always maintain appropriate stop loss. Stop loss is a very important thing which we should keep in mind. No matter what the market, it be cash market, equity futures, sorry, currency market, commodities market, anything. You have to keep stop loss not in your mind but in your system, so that even if you end up losing your money, you don't end up losing a lot of money that is like beyond the power of you losing it. So this is something which we had for you all for this session. I think I lost my connection. Were you all able to listen me properly?
Yes, sir.
Yes,
Yes, sir.
yes.
Listening.
So I
Yeah.
just wanted to ask a question that is it possible to become like full-time trader? Is it really feasible for people like us who are just starting or do not have some financial backup?
Sir, this is a very like subjective or this type of answer. Like it completely depends on what do you want to do in life. Do you have a very good zeal to learn about markets? Are you able or are you willing to invest yourself in the market? There are many things that you can learn, but just like I am assuming that you are also a student only, so it is really
Yeah.
like it is a very important aspect or a very important phase of our life. If you think that you have gained a very good knowledge about the market and you are backtesting yourself, you are gaining some confidence, then like what is the issue if you can become a good and successful trader? Like
No, as I said, because there is no other form of earning, right? We are just students right now. So, is it very risky to go directly dive into stock market, or shall we do some other kind of job, and when we have some backup, then we can enter the stock market, like as in full-time trader?
okay, like right now you don't have any source of income, so you will either buy from
Yeah,
your
exactly. Yeah.
yeah, so you will either buy from your parents or from your friends, uh, but keep this in mind. If you want to trade in stock markets, please trade on your money only. Don't borrow it from someone else, because if you will borrow and lose your money, you will have a headache that yes, I have to pay this money to someone else and I am losing it. But if it will be your money, then even if you make some loss, you can hold your position in the market. Okay. Another thing, just like you are right now understanding what is the functionalities of market, I would really suggest you, like if you have gained some knowledge, if you really want to do something in market, don't directly jump into market. First, initially, like do some paper trading, or like open your account, like open your chart, analyze these stocks, whatever we have discussed in this whole sessions. Okay, as per those strategies or any other strategy that you feel is much more better than what we have discussed, go and test that strategy, go and get some confidence, because it will happen for sure that since you are beginning, out of 5 out of your 10 trading calls, you will make money, but in 5 you will lose your money, that is for sure. But those 5 calls in which you will lose your money will give you a better understanding, like what were the main reason why you failed in your calls. Sometime it will be like MECD line was giving me a call and it was about to cut, so I took a position. that yes, I will make some more profit in this situation because tomorrow it will cut for sure. But what will happen, what can happen in next day, it might get deviated downwards again. This is something which happened with me a lot of times when I was very beginner. So once you start paper trading, you will get to know like what is the actual situation. It will help you to gain some confidence, some patience, because in market it is really important that you remain patient. Okay. And like satisfying yourself with a lesser profit is much more good like option, rather than going for a call that is a potential call but might like end up you into a situation where you lose your money. So a lesser profit is way bigger than a loss. Even a 5 rupee loss is way like way bigger. Or like if I'm entering into a trade, say it had the potential of giving me 100 rupees profit. Okay, I entered late, so I earned 90 rupees as a profit. It is good situation till right now as well, because I made 90 rupee profit. If you lose 5 rupee as well, it will hurt you more. So in order to become a full-time trader, I would like request you initially go and do paper tradings. There are many apps right now in which you have a virtual money, you can invest your money and see the returns. Like every day you analyze stocks, invest your money and see how they performed. If you made a loss, you will get to know like what is the mistake you have committed, and if you will make profits, it will give you good amount of confidence.
Yes, sir. Got it. Got it. Thank you very much.
Yeah, thank you so much. Anyone else have any query? Please feel free to ask me. Otherwise, I think we are good to wrap up this whole session.
Yes, sir.